Hello there. We've just had one of our defined returns products kick out, and it's a really interesting product to look at because it really demonstrates the virtue of patience. The SocGen defined returns product, we've had it for 5 years, and it's been a bit of a frustration, to be honest, through a lot of that time. There's been a couple of times where it's very nearly kicked out because in order to get kick out in the market, it just needs to be just back to or slightly above the starting level it was when the product was set up. And we've had a couple of times where it's only just missed out on kick out, and it's been really frustrating. But over 5 years, it has now produced a really nice return. It produced 9.5% per annum, which is what it always promised to pay, which is a 47.5% return, and that's way more than the FTSE 100 that it's based on. So it's been a very successful product. We just had to be patient, and we ended up with a really good return. So it begs the question, what are we going to do with the money? Well, right now we are feeling a little bit more cautious on equities. We do think there is, it looks like we're going into some sort of recession, whether that's going to be a mild one or a steep one, we don't know yet. And so, and equities have rebounded reasonably well over the past few weeks. So we're just a little bit cautious that there could be a bit of a further dip. But having said that, we still do see some value if we can take a long-term view, in particular for our more adventurous portfolios. We think UK equities look pretty good value. UK equities are fairly cheap, really, relative to the rest of the world. A lot of international investors have been avoiding the UK since Brexit, but actually they may now start looking at things again. That discount that the UK market has compared to the rest of the world looks pretty wide now, and on top of that, you have a very cheap currency relative to other currencies around the world. So that makes things look fairly attractive for international investors looking for bargains. So we think for our more adventurous mandates, we put some of that SocGen money back into UK equities. For the more cautious ones though, we're actually instead been looking at bonds. We think you can get some pretty good returns from bonds, from fixed interest, in particular looking at shorter dated bonds. At the moment, we know central banks are putting up interest rates and they're expected to keep doing that for a little bit longer. Maybe we're near the peak, but perhaps they might go a little bit higher first. But then markets are expecting interest rates to be cut again. What that means is that longer dated bonds actually at the moment have a lower yield than shorter dated bonds. That's because not only are they building in to their prices the interest rates going up, they're building into the prices interest rates going back down again. Whereas shorter dated bonds are just factoring in those rate hikes that we might see in the short term. So there are certain short dated bond funds that we can invest in at the moment that will give us 7 or 8% yield over 1 or 2 years. And that looks quite attractive to us for our more cautious portfolios at the moment, just with the level of uncertainty out there right now. So we are quite optimistic about the future. I think there's some really good opportunities. We just need to be a bit selective about what those opportunities are. So we just want to take this opportunity to say Merry Christmas to all our friends and clients out there and have a Happy New Year, and we'll see you soon. Take care.